There we go. So the formula for cap rates, you use the T formula. The annual net operating income goes up top, property value on one side, and the cap rate on the other. Whatever is the missing number you're trying to figure out, you divide down, multiply across to find that missing number. And the gross rent multiplier, the GRM, the reverse T formula only works for figuring that out. So the property value goes up top. The large number goes up top in this instance. It's the reverse of what's normal. And the small number on the bottom. But what the small number is different. Instead of the annual net operating income, it's the gross monthly income. And then the number on the other side is not a percentage. It is a whole number. The GRM is a multiplier. That's a whole number. It's not a percentage or a rate. All right. And the three approaches to value are the sales comparison approach, the cost approach, and the income approach. The appraiser will try to use all three approaches if possible, and then use the more profitable one. So when you apply more than one of the three approaches to value to the same property, that's called reconciliation. That's a term we need to know. So let's highlight it on page 316, reconciliation. If more than one of the three approaches to value are used on the same property, it's called reconciliation. So which approach to value are you most likely to use in determining the value of a one-family house? What are the three approaches to value? Come on, guys. Just had it on the previous slide. What are the three approaches to value? Here. Sales comparison approach, the cost approach, and the income approach. Which one of those three approaches to value would you use for a single family house?
CMA.
The sales comparison approach. And we use that in a CMA. The CMA is that the analysis, but the approach to value is the sales comparison approach. Which approach to value would you use for valuing a apartment building?
Income approach.
The income approach. What about a four-family house?
Cost approach.
It could be, well, not the cost approach. You'd use either the sales comparison or the income approach. Cost approach is used to determine the value of buildings that may not have comparables or generate income in a normal fashion. Unique, special, one-of-a-kind buildings, how to value a church, city hall, custom home that may not have comparables, that you would use the cost approach. You can see down here. Cost approach is of limited value unless the home is of relatively new. Therefore, a sales comparison approach is usually given the greatest weight, valuing single-family residence. In the appraisal of income or investment property, the income approach normally would be given the greatest weight. And the appraisal of churches, libraries, museums, schools, and other special use properties where there's little or no income and sales revenue, and often no comparable sales to compare it to, the cost approach would be the one that's given the greatest weight. Okay. So once again, here is the T formula. And here's the T formula and all the different math problems that you use to figure out. We're going to be using it to figure out number 3 here, the cap rate. So we need the net income, net annual income, cap rate, and market value. So let's start off with one here about your commissions. If you charge a seller 6% commission and the total commission collected is $21,600, how much did the property sell for? Well, I already plugged the numbers into the T formula here for you. Small number always goes up top, and that would be the commission that's collected versus the sale price. Then you got the percentage that you charged the owner, which was 6%. So what did the property sell for?
$360,000.
Yep. Okay. And if the house sold for 360 and the agent charged 6% commission, how much did the total commission be? 360 times 6%. That'll give you your total commission.
21,600.
Yep. All right, so let's get into cap rates now. What is a cap rate? What is cap short for?
Capitalization.
Capitalization rate. And what is a capitalization rate or cap rate? It's a way of measuring the rate of return on an investor's money. You invest the money to buy the property. How much are you making off of that money? Off that investment? Wouldn't you want to know that if you're investing your money? So the cap rate is an important number. We need to know what that is. It's the rate of return on the investor's money. You invest $400,000, how long will it take them to get it back? You know, what is his return? So in this problem, there's a question here. If a property sells for $340,000 with 3 units that rent for $1,200 a month each, with the following expenses, what would the cap rate be? So, any numbers we could plug in here now into that T formula?
Yeah, the 400,000.
Where does that go?
The big number goes, uh, if you move like on this corner, it's hard to
On top or bottom?
bottom, not the percent one, the other side.
Okay, so, well, first we're going to need, so what goes on top then?
The net,
The net income, and how we calculate the net.
I think you're gonna have to take all these expenses. All right,
And continue.
add them.
Okay, you add up all the expenses, make sure they're annual,
Mm-hmm.
You got some here that are monthly, quarterly, annual. Add them all up, make sure they're all annual expenses, except for the mortgage payment. Don't use that because that'll be different for the next owner. And so then we take those annual figures, the income minus the expenses, and we're left with the net. So we got the income of $43,200 because we got 3 units that rent for $1,200 a month each with the following expense. So $1,200 a month times 3 times 12 is $43,200. Everybody agree with that?
Yeah.
Okay, then we add up all the expenses here, and I got 16,560, and subtract that, and you're left with $26,640 a month. I'm sorry, a year net income. That's in your pocket after expenses. Not bad for just owning the real estate and renting it out to someone, right? That's what we call passive income, even though it's not totally passive. We got to deal with tenants. But other than that, it is kind of passive income because it's kind of hands off just for owning the real estate. That's how much money we net in our pockets after the expenses each year. That's not bad, right? It's not a bad income for pretty much doing nothing.
Mm-hmm.
So we put the 400,000 down the bottom and 2640 up top, the annual net income. Divide that by 400,000 and we get a cap rate of, drum roll please. What do we get a cap rate of?
.06.
0.06, that would be 6%. Oh, it looks like it was 0.066, right? So
Yeah, 666.
6.6% cap rate. Is that a good rate of return on your investment, on your money? How much are your banks paying you these days? Is it a good investment? Is that a good return? Yeah, it's decent. 6.6% return on your money. You're not making that in your bank account or most high yield checking accounts even right now, or savings accounts. So yeah, that's a decent return. All right, so let's do it again. Here's one. Let's see. Now let's calculate what the GRM is for that previous property that got us that 6.6% cap rate of return on our investment from that previous slide. The value of the property is 400,000 and the gross monthly income is 3,600. So what's the GRM on this property? What formula do we need to use to calculate the GRM? I got it here, but what do we call this formula?
The T formula?
Where the large number goes up top.
Yeah.
Reverse.
The reverse T formula. You know, because usually the small number goes up top. So 400,000 goes up top. Gross monthly income goes on bottom. And what did you get for the GRM?
111.11.
Yep. Is that a good number or a bad number? There's no such thing as a good or bad GRM. It's just an insignificant number that we applied to this property. We've calculated and we figured out that a property in this neighborhood that's getting you a 6.6% cap rate has a GRM of 111.11. So now we could find another property that comes on the market that's similar, how many units it is. And then we can take this GRM and apply it to the other property, and we should be able to calculate what we should offer on it to get that same cap rate of return. I'm guesstimating that the numbers should be the same approximately. Expenses, income. Okay, so here's another one for the GRM. If the property is for sale for $425,000 with $9,500 a year in taxes, $900 a year in insurance and rents, and annual rents of $28,000 a year, and the property expenses at $12,500 a year, what is the GRM for this property? What numbers do we need to know for GRM? Is the first thing you should be asking yourself.
The value and the income.
You need the value and what income?
The rent income, the rental income.
Okay, and that's how much?
It's not given here.
Annual rents of $28,000 a year.
Oh, sorry, 900 year insurance annual rents. Yes, sorry. I thought I didn't see the 900.
Okay, so what numbers do we plug in where? What numbers do we need?
You need
The
the
425 and the 28.
425 goes where?
on the top.
On the top.
And then for the rent, you take the 28 and you divide it by 12
Why?
because you need the monthly.
You need the gross monthly income.
So you divide it by 12 and you get 2,333.33.
Okay. And then you get,
Um,
what's the GRM for this property?
$182.17.
There you go. The thing is, you need to know the T formula makes it easy, but the thing is, you need to know what numbers to plug into the T formula or the reverse T formula in this case, where the large number goes up top and the gross monthly income on the bottom. This question gave you a bunch of additional numbers that you didn't need. You don't need to know the taxes or the annual insurance or the expenses on the property. The whole idea of this question giving you that extra information is to see if you know what the hell you're looking for. Or if you're just plugging in numbers, hoping that it matches to one of the answers. Okay. This is the type of thing they could do to you on exam. And I taught you that the reverse T formula is good for calculating the GRM. And what numbers you need for the GRM is the value and the gross monthly income. And then you plug in the numbers and it's pretty easy, isn't it? To do the math, especially with a calculator, right? All right, so here's a problem that we're going to have here for figuring out. This is one of two parts because we're going to then end up comparing it to another property. So an investor says that he'll purchase this property if he could get an 8% return on his investment. That's asking for a lot. Will he get it? And what is the actual cap rate? I already calculated the income here for you. There are 2 3-bedroom units renting for $1,500 a month each. So 1,500 times 2 is 3,000. 2 2-bedrooms renting for $1,200 a month each times 2, that's 2,400. 2,400 plus the 3,000 is 5,400. Times it by 12, and there's your annual gross operating income of 64,800. Then here's all your expenses. I already added them up for you, 23,520. So what do we do now? I mean, I can't do everything for you. What do I got to do now to figure this out? We're trying to figure out the cap rate on the property. What numbers do we need for the cap rate? Hello?
The
You need the
property
net.
value and the annual,
And the annual what? You got to know the numbers. So I'm not even asking you for the numbers. I'm asking you for what are we trying to figure out?
You want the cap rate, so you need the annual net operating income on top.
And how do we get the annual net operating income?
You take the 64,800 minus the expenses, the 23,520. And that gives 41,280.
And now what?
You have the sales price. Yes,
Okay.
425
Where's that go?
on the bottom of the T on the side. And then you should get the percent on the side.
Oh, we got one number here. Where does the other number go?
The
What's the
net goes on top.
okay?
And 41,280 divided by it's gonna be 9.71%.
So the annual net operating income, 41,280 divided by 425 will give us the cap rate, right?
Yes.
Of 9.7. Is that what you got? Okay.
Yeah.
Now for the same property, what's the gross rent multiplier? Let's use the reverse T formula here. What numbers do we need to plug into this reverse T formula to figure out the GRM? Anybody? Anybody? Bueller? What numbers do we plug in to figure out the GRM?
You put the sale price on top, the 425, and then you need the rent on the bottom of the T.
What rent?
The net. No, the gross. The
The
gross.
gross
The gross.
monthly.
Yes.
The gross monthly. GRM, gross monthly rent for that GRM. It's $5,400.
Okay.
And then divide down, and we get the GRM of
78.70.
yep. Guys, it's not difficult. You just need to remember what numbers go into the T formula and what numbers go into the reverse T formula. And then the rest is just a matter of doing the math with your calculator, which is all simple math. Okay. You need to know which numbers you need to plug in. It's not difficult. Don't hyperventilate when I say math. Okay. These are simple numbers. We just need to know what numbers to plug into the T formula to figure out the cap rate and what numbers we need to plug into the reverse T formula to figure out the GRM. Okay, it's annual net, the value to figure out the cap rate, the value up top, and the gross monthly income to calculate the GRM. Okay, so now we're going to take these numbers because another 4-unit building is going to come on the market for sale. And we don't have all the numbers for that property. And this one has 3 3-bedroom units. So we're just going to estimate using the income from the other property, which was $1,500 a month for a 3-bedroom unit. And it was $1,200 for a 2-bedroom. So that other building had 2 3-bedrooms and 2 2-bedrooms. This one has 3 3-bedrooms and 1 2-bedroom. So we're going to take an educated guesstimate and apply those numbers to this property, which is in the same neighborhood, because the rents should be approximately the same, give or take, to get you in the ballpark. And the expenses to maintain a 4-unit building versus another 4-unit building in the same area should be approximately the same, not too far off. Right? So this is basically just using a guesstimate, a little bit of guesstimation here when we don't have the exact numbers. And in order to get the exact numbers, we'd have to make a request to the property owner, and they may want us to sign a contract called the NDA, a non-disclosure agreement, so that we don't disclose the numbers and figures that they give us. And if we do, then we could be opening ourselves to lawsuits and everything. And this is just to figure out if this is a property we even want to show to our client. So instead of going through all that rigmarole, what we'll do is we'll just do some guesstimation of what the rents are based on what other 3 units and 2 units are going for in that area. And should get us in the same ballpark, right? So we add up the total monthly incomes here, and we get $5,700 a month. And now we could put it in the reverse T formula on this side. And we knew that the building on the previous slide at a 9% cap rate had a 78.70 GRM. So we're going to apply it to this building because we know it'll get us that same cap rate, or in the ballpark. So what's the maximum we should offer on this property to get us in that same GRM range, which will then net us the same cap rate?
448, 590.
There you go. See how if you're missing a number and you got the other two, you could figure it out. And this is how we calculated the GRM on the other building on the previous slide that got us that higher cap rate range. And we applied it to this property. But you could only apply it because that was a 4-unit building and this is a 4-unit building. You could only do that to compare similar properties. 3-unit to a 3-unit, a 4-unit to a 4-unit. You can't compare a 3-unit building to a 4-unit building. It won't work. Okay. So this is in all practicality how to actually use this reverse T formula. Here. You want to snap a picture of this, how we calculated this problem, and then we related it to the next one to figure out? Or you could just watch the recording and see how we figured it out, or I do the walkthrough. Okay. Next, we're going to calculate depreciation. Probably one of the harder problems. It's not that hard though. When I start explaining this, you may get your mind may start getting a little boggled though. Don't worry about it. When we actually get into the problem, you could see it's the instructions are actually a lot easier. So there's a couple steps to this when calculating appreciation or depreciation. Usually we're going to get a math problem, probably calculating depreciation of a property. Now, the first step is figuring out if you're going to be using the straight line method or the compounding method. If the problem doesn't tell you which method to use, you're going to use the straight line method. Okay. What's the difference between the straight line method and the compound method? Well, the straight line method, when it tells you to calculate depreciation, you just do the problem one time. In the compounding method, you're going to use the problem once for each year that it depreciated. But before we get to that point, how do we calculate appreciation or depreciation? Well, first off, anytime you're calculating value, you got to write down 100% and start with 100%. And depreciation is a loss of value, so you're going to put a subtraction symbol next to 100%. If it appreciated, you would put a plus sign. And then the rate of depreciation. Now, are you trying to calculate how much the property was worth in the past, or are you trying to calculate the current value of a property? If you're trying to calculate a value in the past, you've got to divide. If you're trying to figure out a current or future value, you will multiply in this problem. So let me set up the question here, and I got some instructions on the left side here for you still so that you could follow along. If you purchased a property 3 years ago and it depreciated in value 2% per year, and today's value is $400,000, how much did you purchase the property for? Using the straight line method. Well, if you're using the straight line method, step 2 here says, well, you write down 100% and it depreciated, so we're going to have to subtract from 100%, but how much? Well, it says to use the straight line method, take the number of years and times it by the rate of depreciation. So 3 years times 2 is what?
6.
So there we go. 2 times 3 is 6. Starts with 100%. It depreciated, so we're going to subtract. If it appreciated, you would have added. So we're subtracting 6%. That gives us 94%. Today's value is $400,000. So are we trying to figure out a value in the past or a future value?
The past.
The past. So we're going to divide. So we take the current value of 400,000, divide it by 0.94, and then we get our answer. It's just a couple more steps, but it's pretty easy to figure out still. So let's do another problem. This time, we're going to use the compound method. I'll show you how the compound method is different. So I'm first showing you how to do this, and then you're going to do some on your own here, okay? So here we got the same question as above. We're using the same question, but we're going to use the compound method. So if you purchased a property 3 years ago and it depreciated in value 2% per year, and today's value is $400,000, once again, we're going to start off with 100%, but we're not going to take this shortcut of 2 times 3, the number of years, the rate of depreciation times the number of years, and then subtract it. We're just going to subtract the rate of depreciation, the 2% from 100, which gives us 0.98. And then we're going to do this math problem once for each year. So we're going to compound for each year, 400,000 divided by, because we're trying to figure out a value in the past still, 0.98. So that was 1 year ago. Now we take this figure, divide it by 0.98 again. That was 2 years ago. And we take that figure, we're going to divide it by 0.98 again. And that gives us the answer of 424,993. So this is how you do the straight line method. You do the problem once, but you take the rate of depreciation times it by the number of years before you subtract it from 100. Over here, you don't do that in the compounding method. Instead, you just subtract the rate of depreciation from 100, and then you do the math problem once for each year. Everybody follow me on that?
So I have a question. I'm driving, so I can't really see what you're doing, but as I'm listening, how do you know how do you know when to do the straight line method and when to do the compound method?
Because they'll tell you in the question.
Oh, but so for this question, you just did an example of both because the answers is 2 different answers.
Correct. We did it using the straight line method, and we did it using the compound method. If the problem does not tell you which method to use, you'll use the straight line method.
Okay.
So you only use the compound method if they tell you to use that method.
Okay.
But in real life, we'll never do this in real life. This is appraisers. We don't have the knowledge to complete this. I mean, we could figure this out. We could do this part of the math, but this is part of a, oh, which valuation is it? This is part of the oh my God, I'm having a brain fart here. I have to look back. I'm having a brain fart. Give me 1 second here. This is part of the cost approach. Okay. To value. And we're calculating the rate of depreciation of the building, right? This is how they do that. So we'll never really do this because we never use the cost approach. We simply don't have the knowledge for how to calculate what the cost to construct a new building are, for example. We're not going to have that knowledge. That's the appraiser would. We don't. But I guess we need to know what the appraiser does in their calculations for some reason. So that's why we get this problem. I've never done this problem in my life, never needed to. Just on exams. Okay, so here's another question using the same thing. If you purchased the property 3 years ago and it depreciated in value 2% per year, and today's value is $380,000, how much did you buy the property for using the compound method? So what's the step? What do we do?
Hey, Lynn.
No, Mr. Johnson today.
So when trying to figure out the values, what do we have to do here? What's the first step? You write down 100%, right? And using the compound method, what do we do? 100% minus, because it depreciated, so that's a minus. Minus what?
1.
Minus 1.
Minus 2%.
There you go. Minus 2%. 100% minus 2%, that's 98%. And then walk me through it. Then what?
Now you're doing it by years, right? Since it's 3 years, you're going to do each one individually.
Okay, so we do the math problem once for each year when we're using the compound method. So you can see here, using the straight, look at the instructions. I got the instructions right here on the side here for you. You know, if you use the straight line method, you take the number of years times the rate of depreciation. If compounding, just use the rate of depreciation and do the math problem once a year. So that's why we just use the rate of depreciation here, subtracted from 100%. And now we're going to do the math problem once for each year. So what's the math problem? What numbers do we do? What numbers do I got to put here on the right?
380,000.
Okay.
It's depreciating, so you're divided by 0.98.
Okay, well, 1 second. Depreciation is a matter of whether we put a minus sign or a plus sign here. Whether we put a division or a multiplication is if we're trying to figure out a value in the past or a future value.
Okay.
Yeah, I just wanted to stop you there so you have that understanding.
So you divide because it's in the past.
Okay, so 380 divided by 0.98.
That gives you 1 year. So now you got to do it with that new value again.
And then again.
And one more time.
For once for each year. Okay? Just want you to know the formulas. I mean, the math is simple and you got a calculator, you know, so I'm not worried about the math. I'm worried about you knowing the steps on how to figure it out. Okay? That's what I'm trying to get out of you guys. I want you guys to remember the steps. Okay? So let's do another one. In this one, it's a little different though. Pay attention. If you purchased a property 3 years ago for 380 and it depreciated 2% per year using the compound method, what is it worth today? So what do we do? What's the first step in trying to figure out value?
Take 100 minus 2%.
It starts with 100%. So 100% minus 2 because we're doing the compound method. If we did straight line, we just take rate of depreciation times the number of years, but we're doing compound method. So 100% minus 2% is 98%. And then what?
You take the 380 divided by 0.98.
Okay, hold on a second. Why are we dividing?
It's past value. So, you're looking for present, so it'll be multiplication.
Uh-huh. You see? So there you go. Now, here's a way that you could tell if if you're doing it right or not. Because if you're dividing it, your number should be going up. If you're multiplying it, your number should be going down. And if you bought it in the past for 380 and your property depreciated for 3 years, it should be worth less today, right? Now, if they're giving you a current value and they're asking you how much you bought it for and they told you that it depreciated, then you should have bought it for more. So your number should be going up. That's the way to try to apply a little logic to it to see if you're doing the math problem right or not. Okay, so we do this once for each year, just like we did over here. The only difference is we're multiplying because we're trying to figure out what the property's worth today. And there you go. The number goes down. Right? So you can either watch this video or snap pictures of these slides on how to figure it out. The steps are here on the left-hand side I put together for you for the problems. And here we got two different versions of the compound method. One calculating the past value and one calculating the current or future value. All right, so appraising is a profession conducted by skilled, licensed, independent appraisers that do evaluation in exchange for a fee. As real estate agents, we help people determine value. We cannot call it an appraisal because we're not licensed appraisers. And we help the public by doing CMAs, the comparative market analysis. And we do that usually complimentary. However, for lenders, we do BPOs, which we do that in exchange for a fee. But if we do, who do we need to collect that fee through? If we're doing a BPO, broker's pricing opinion, for a lender, and they're going to pay us for that, do we get paid directly by the lender?
You get paid by the broker.
It's got to go through our broker because you could only be paid by your broker. So why do people get appraisals? Well, here's a bunch of reasons. Estate purposes, divorce proceedings, for financing, to get the financing to buy a property or refinancing, for taxation reasons, for relocation, for condemnation proceedings, for, eminent domain there, for insurance reasons, damage and loss studies for tax deductions, and feasibility for the studies of consequences of a particular use for a property. So these are reasons that we do them. Okay. So the appraisal process the appraiser goes through is they got to figure out what the problem is they're trying to solve. Then list the data needed and their sources. Gather, record, and verify that necessary data. Determine the highest and best use of the land. Estimate the land value. Estimate value by each of the three approaches, which are, what are the three approaches to value?
Cost approach, sales approach, and it's one more.
Income. So sales comparison approach, the cost approach, and the income approach to value. Then we reconcile the estimated value. Reconciliation means what? What is reconciliation? When you apply more than one of the three approaches to value to the same property. And then you report the final value on the report. Okay, so appraisers use the form that they use is called the Uniform Residential Appraisal Report. Okay. Appraisers have to follow their code of ethics like we do. They call theirs USPAP, the Uniform Standards of Professional Appraisal Practice. Page 318, you could find that in the last, next to the last bulleted item. Uniform Standards of Professional Appraisal Practice, USPAP. Those are those guidelines that they need to follow. And they need to take that 12-hour national USPAP course, 12 or 15 hours, I forget, every 2 years. This is what the sample Uniform Residential Appraisal Report looks like on page 319. And MAI is the member of the Appraisal Institute. So appraisers would become members of MAI, like we become members of NAR. Now here, I got this circled, and I got some things highlighted here. So CMAs are provided to sellers or buyers, and BPOs are ordered by lenders. Now, New Jersey requires appraisals comply with state standards and be performed by state licensed or certified appraisers. An exemption is allowed in the rare event where a broker's price opinion, a BPO, is acceptable to a lender. They may order a BPO from us. But we should write on there that it should not be considered the equivalent of an appraisal prepared by a New Jersey licensed or certified real estate appraiser. The statement should appear in a print size as large as the main text on the report, and any fees involved are payable directly to the agent's broker of record, and we get paid through our broker. All right. You want information about becoming an appraiser? Well, we could also get credits as real estate licensees for doing our CMAs towards getting our appraiser's license. So keep track of all the CMAs you do. And you can get more information from State Board of Appraisers there on Halsey Street in Newark. Their website, njconsumeraffairs.gov/REA, if you're interested in becoming an appraiser. But that's the next industry that they keep slamming now as being racist. So just be aware of that. So there's going to be a lot of nonsense going on in that industry about coming down on all the appraisers, because people don't agree with the valuation that they were given on their property. They claim it's racist. Okay. Now that you may find a rare instance of that or two in some other states, but I doubt you're going to find that in New Jersey. I think they found one, they were doing a presentation I was watching from the New Jersey Division of Consumer Affairs, the Department of Law and Public Safety and Civil Rights. Their job is just to look for all kinds of, possible violations where somebody's rights are being infringed on. And this is like the next big thing that they keep bringing up now. So we'll see this blow up a little bit now too, because you get people who they complain that the appraiser doesn't appraise their property for enough money when they're trying to buy it, you know, and then when they're getting a property appraised for taxation reasons, they complain that their property is being overvalued. And then when they go to sell it, they say, "Oh, well, you're not appraising my property for enough money again." You know, so it's, but you know, depending on the situation, I guess the person is in, to try to get their answer, they'll say that it's because of racism instead of the comparables that they showed as evidence in their report. I mean, it's easy enough to look at the comparables that you're using in the report. I mean, I don't know how they could even make such a claim, you know, when you're using empirical evidence of recently sold property similar in size, style, location, and amenity, and then you're making adjustments for the differences. It's not like appraisers are pulling these numbers out of thin air. So, but it was an interesting thing in that presentation, and you could sign up to watch some of these presentations that they give for different industries like appraisals and stuff like that, and you can see where the industry's going with this stuff. Okay, so anyway, the appraiser, apprentice and trainee, you could become an apprentice trainee appraiser after 90 hours. Once again, then you could graduate to become a licensed residential appraiser after 150 hours more class and 2,000 hours of experience as an apprentice. Then you could move on to become a certified residential appraiser. You got to have a college degree or some classes here and have 2,500 hours of experience in 2 years. And then you could appraise residential properties with no monetary limitations on it. But if you want to appraise commercial properties, then you need to graduate to get that certified general appraiser's license. And you need to have 300 additional hours of class and 3,000 hours of experience in not less than 2.5 years, with half of those appraisals being done on non-residential properties. And in order to do that, you needed to work underneath a certified general appraiser to do appraisals on commercial properties during that period. All right, and then they have no monetary caps on any type or any limitations on types of properties for certified general appraiser for the types of properties they can appraise. But in every case, all appraiser licenses have to take that national 15-hour USPAP course, Uniform Standards of Professional Appraisal Practice, at least every 2 years.
So is that certified general appraiser like their broker?
Yeah, because it's like the highest type of license you could get. Yeah. All right, so here's that slide again for the different types of appraiser licenses and what they can do with those licenses. If you didn't get it yesterday, snap a pic now. Talks about MAI, USPAP, the different types of licenses and what kind of properties they can appraise. And what kind of appraiser license is required to do an appraisal? What kind of license is required to do an appraisal?
Apprentice trainee.
An appraiser's license. It's just a general question. What type of license is required to do an appraisal? It's an appraiser's license. Now, if I gave you more information, then you could answer which type of specific license is required to do anything. You know, like certified residential appraisers, they could only appraise residential properties with no dollar cap or limitation. They could do commercial appraisals only under the supervision of a certified general appraiser. Licensed residential appraiser can only appraise residential properties up to $1 million. And certified general appraiser can appraise any property with no caps or limitations. All right, so appraising, the profession of appraising has designation courses, just like we have in real estate. If you want to do any kinds of appraisals on FHA properties, you have to have that FHA designation to do appraisals using for FHA loans. You have to have that FHA designation on your license as well, that you took the class as that appraiser. Appraisals are performed as part of federally related transactions. They must comply with state standards and be performed by state licensed or certified appraisers. We as real estate agents, we do CMAs. That's a comparative market analysis used by real estate licensees to help home sellers and buyers determine the current market value of a property using the sales comparison approach. This is usually complimentary for free. We do BPOs, broker price opinions, when licensees prepare valuation reports similar to an appraisal for banks. However, they must never be called appraisals. Usually performed for free, which must be, or for a fee that must be paid through your broker. And both CMAs and BPOs have to have a disclosure on them saying that this is not an appraisal and should not be considered the equivalent of one performed by a licensed, state licensed, or certified appraiser. And here's just some more math problems for calculating depreciation stuff that you could do on your own if you wanted some more problems there. I got a couple more here. Well, actually here, this one we could do on our own. Here, I'll give you one last math problem here before we're done with this chapter. You purchased a property 3 years ago, depreciated 2% per year. Today's value is $375,000. How much did you buy the property for? And first do the straight line method and then do the compound method. So do the straight line method first, then we'll see if you got it right. So go. Do it all on your own without any instructions now. Oh, junk. See if you're paying attention. Today's property value is $375,000. It depreciated 2% per year 3 years ago. Using the straight line method, how much did we buy it for? Well, how do we start off determining the value of any property? What's the first thing we do? We write down 100%. We're trying to figure out all the value. And then, did we? Go ahead.
I was going to say it would be 98%.
Okay, so are we adding or so we're subtracting from 100% then, right? And why are we subtracting from 100% instead of adding?
Because it depreciated.
Because it depreciated. It sounds like a good reason. Okay, so it's 100% minus 2% is 98% or 0.98. And then what do we do?
We multiply because we want to see what it was when you first bought it.
Well, when you're looking in the past, you have to divide. When you look at a current or future value, you multiply. So we got to divide today because it's giving us today's value. So we're trying to figure out a value in the past. So you have to divide for calculating a past value. So we do 375 divided by
98.
0.98 or 98%. And do we do that once or do we do it 3 times?
Once.
Okay. Well, first of all, let's back this up a bit because we're doing the straight line method. When you do the straight line method and you do the problem one time, it's because we have to not just do the 2%, we have to do the 2 times 3. So 2 times 3 is 6 minus 100. Okay, so that gives us 0.94. 375 divided by 0.94, that's 398,936. Okay, now if we're doing the compound method, we could do that 100 minus 2%, because then we do the math problem 3 times, once for each year. Okay. And are we going to multiply or divide?
Divide because you're getting the past.
We're still dividing because we're still trying to figure out a value in the past. So 100% minus the 2% is 0.98. And then we do that problem once for each year. 375 divided by 0.98 once, twice, thrice to get the answer. Okay. And that's it. That concludes chapter 16. A lot of terms in there, some math, right? We had a bit of math in that chapter as well. Before we get started in the key terms, in key terms 1, next to the letter J, at the end of the letter J there, write to compare income producing properties. To compare income producing properties. All right. Next to letter J, you wrote to compare income producing properties. Everybody get that? That's the only modification we need to do. Yes. Okay.
Yeah.
So let's get started. Process of estimating value.
Appraisal.
2 is A, appraisal. State of return, rate of return demanded by investors in a particular area. What do we call the rate of return on an investor's money?
Cap rate.
Cap rate, capitalization or cap rate. So 4 is B. A similar nearby property recently sold.
Comparable.
5 is C. Extra that contributes to the owner's satisfaction, like clean air, nice views, and so on.
Amenity.
It's an amenity. 1 is D. An independent person trained to provide an unbiased estimate or opinion of value.
Appraiser.
3 is E, appraiser. Analysis of income, including rental and other factors.
Gross rental. Rent multiplier.
And
Oh, never mind.
of income, wait, hold on a second. Of rental income and other factors. Like getting money from a concession stand as well. That's non-real estate related. So analysis of income, including rental and from other factors.
So gross income.
That's the gross income multiplier, the GIM. The 10 is F. Loss of value due to any cause or condition.
Depreciation.
7 is G. Loss of value due to factors beyond the property's boundaries.
External obsolescence.
Yes, external obsolescence. 8 is H. Loss of value due to worn or outdated features. They said outmoded. I guess that means outdated. Outdated features.
Function.
I'm sorry, what'd you say?
Functional.
Oh, yeah,
Obsolescence.
functional obsolescence. 9 is I. Analysis of rental income used roughly in the sales comparison approach to compare income producing properties.
Rent, gross rent multiplier.
11 is J, the gross rent multiplier. Appraisal technique that analyzes the cost to build.
Cost approach.
The cost approach. 6 is K. Analysis of value of property using return on investment.
Income approach.
Income approach. And when using the income approach, you could use the cap rates or the gross rent multiplier, the GRM, right? So 13 is L. And use of land that yields the most money. What is that referred to as?
Highest and best use.
The highest and best use. 12 is M. Okay, key terms 2. What a property actually sells for.
Market price.
1 is A. Loss of value due to wear and tear.
Physical deterioration.
3 is B. Location and the buyer's willingness to pay more for certain locations.
Situs.
8 is C. Situs or situs. We find that perfect location. We sit us right here. Right? 8 is C. Analysis of values received by different appraisal approaches.
Reconciliation.
Reconciliation. 4 is D. Present worth of future benefits.
Value.
That's the definition of value, correct. 11 is E. A cost to rebuild using today's materials and techniques.
Reproduction cost. Replacement.
Using today's techniques, that's not necessarily an exact duplicate.
Replacement.
Replacement cost. 5 is F. A price that would be paid by an informed buyer. How do we help people become informed about the price?
Market value.
The market value. 2 is G. Appraisal technique that analyzes the sales price of comparable properties.
Sales comparison approach.
7 is H. Sales comparison approach. Cost to rebuild exactly using materials just like the original.
Reproduction.
Reproduction. 6 is I. You know, I used to give a little joke over there all the time, but sometimes people will get offended by it. So hopefully nobody gets offended. The way to remember this is, you know, hey, ladies, why do you have children? Oh, to make little mini me's, little duplicates of yourself, exact duplicates of yourself, right? So that's the way to try to remember it, you know, because if you just wanted a child that didn't need to be an exact duplicate, you could always adopt, then you still have a child, right? But it's not an exact duplicate, okay? How do you get an exact duplicate? You reproduce. So reproduction, that's the, I don't know, works for me to remember it. I don't know if it doesn't work for you, don't get offended by it. I wasn't meant to be offensive. Okay. Okay. So, 6 was I, reproduction, cost, principle that no one will pay more if the same can be had for less.
Substitution.
Substitution. 10 is J. And a parcel of real estate being appraised is referred to as
Subject property.
the subject property. 9 is K. And that concludes chapter 16, which had a lot of information in it, and I do suggest you study it.